Welcome back to class today. All right, so today we have a guest lecturer. Our guest lecturer is none other than the author of Trading in the Zone, market wizard Mark Douglas. And I got to thinking, instead of trying to explain all of the trading psychology aspects to you like I do all the time, why not learn from the man who literally wrote the Bible on trading psychology? Now, I don't know how much this book costs. It's not all that thick, and you can get it on Audible as well. But this is worth a million times more than what I paid for it, at least. At least. How many of you in class own this book? Yeah? Okay. Now, the second question is, how many of you in class have read the book? Okay, not bad, not bad, not bad. Well, we're going to learn directly from Mark Douglas today. A little deviation from our normally scheduled Outlier University. However, I have no doubt whatsoever that we are going to learn a ton. So everybody got their popcorn. I got mine in my my Grinch bucket today for Christmas season. Very cool. Everybody's got their popcorn. This is one of my favorite parts of the job of being a professional YouTuber is, just sitting back and relaxing and watching a video with my friends. This is the best part of being a YouTuber. So let's do this together. We're gonna watch this video. And okay, that's coming through. You guys let me know if the sound doesn't come through, but I think it will. I think it will. Let's watch this together.
And using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation.
Not using your method, meaning not having a plan or not following your plan when you have one. Like people who jumped into NVIDIA today because they FOMO'd into it, probably not very happy at this moment, where it was up 5% pre-market. Now it's down 2.3% by the end of the day. Here's a little pro tip. When good news comes out and the market goes down, that is a bearish market. When bad news comes out and stocks still go up, that is a bullish market. NVIDIA has kind of proven the point that we are definitely in a very hard penny market, as Mark would call it. Let's keep going.
Between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, that they can rely on from their trading. And I'm sure.
Who doesn't want consistent results, right? Everybody wants to have control over the market.
That many of your viewers have already realized that's getting a steady income is not such an easy task.
Yeah, and everyone's.
Apologize. I'm going to interrupt this a million times. But how many times have I said, don't try and tell the market when you're going to get paid, right? If you need to get paid by the market in order to make your mortgage, it's a high pressure situation that you don't have to put yourself in. But the problem here is that a lot of people want to assign income from the market when the market will dictate with absolutely no care whatsoever when it actually pays you. So I mentioned hard penny environment. There's 2 types of environments: easy dollar, hard penny. Right now, when the market is trading, in a bearish trend, that's a hard penny environment. You want an easy dollar environment. And again, you don't get to decide when the market is in your favor. And that's why we sit in cash and we don't F up when things aren't working in our favor.
Seems to get trapped thinking that because trading is easy,
right,
or because it's easy to find yourself in a winning trade, exactly, which many people do.
Right.
They think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the two.
It almost seems like there's no relationship between the two.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, you know, it's so easy to find yourself in a winning trade, because winning actually requires no skill at all. In other words, unless you consider that, you know, the being able to click a mouse button or, you know, tap a pad is a skill.
Right. That's what I've been telling you guys, right? This is way easier than digging ditches, way easier than cutting down trees, right? It's literally the just clicking buttons.
And we don't have to have a reason or good reason or even actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of what kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, and it must be pretty darn easy for me to sit there and make a living out of this. You know, and that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're gonna get into that, but at the most general level, I'm gonna say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills. Yeah. Exactly.
Anybody pick that up? Shane, what do you think he's saying right there? I'm still gonna call on you guys in class, just so you know.
Is it people not being normal? You know, it's not normal to think like that.
That's exactly it, right? And it's because if you want to be world class, you can't be normal. They are direct opposites. They are mutually exclusive. And that's what he's trying to say right here. You can't do what normal people do to be successful in the market.
Exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, you know, a high school basketball player who, you know, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
you
not
see that all the
out of the
time.
realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case.
And have y'all heard that before? Focusing in on the process and not the outcome. I mean, that the outcome will happen automatically if you focus in on the process, but your process has to be based on a mathematical positive expectancy. And we'll talk more about how to build a plan and all that stuff later. Because I did get to thinking that I hope I wasn't jumping the gun by getting into psychology first, because I feel like it's the most important part of trading. And then once you have the psychology right, then you can build a plan. But to that point, right, following the plan with a mathematical edge, given enough trades, you should, most dangerous word in finance, end up with something close to what your expectancy actually is. But it's not going to happen over 3 trades or 15 or maybe even 50. But the more trades you make, the closer you can get to that expectancy.
It's obviously of trading or following your method,
right,
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now.
Trying
to stay focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
What are you doing? Fantastic.
Anyway, you know, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know, that's happened to everybody. Okay. Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have. And I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about when we say the word methodology is the wise trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay.
Exactly. Whatever software you use, whatever methodology you use. If you can't follow that to a T, there is no way that you will achieve the expectancy that that software, that methodology, that plan can develop. Just not possible.
Okay, exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis.
Right. Thinking that we have the control over the market, rather than listening what the market is telling us implanting our assumptions, our biases, our beliefs, our profit targets onto the market, which that's a losing endeavor. The market will never listen to you.
And not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's
it's almost like I've listened to this guy before. I tell me if you've heard me say nearly word for word what he's talking about right here. The outcome of any individual trade is random. Art, Senior Wahoo. Have you ever heard that before?
Not from you, never. All the time, on a daily basis.
Yeah, exactly. Because there's nothing we can do about it. It's going to either win or lose. And we don't know what distribution of wins or losses will come into our portfolio. Mr. Skinny Buff Guy William, was there something you were going to say?
No, I was just raising my hand to confirm that I've heard it.
Okay, gotcha. Let's keep going. Are you liking this? Give me a thumbs up if you like doing it with a guest lecture. Okay, cool.
no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
This, you guys have seen me get real worked up. And it's because like you could have one loser. You could come off the back of 17 winners and have one loser, and people will act like everything is broken, right? God forbid you have two losing trades in a row. There was somebody in the Discord the other day. I was like, listen, I really think we need to reevaluate Plan ETF. And I'm like, are you fucking serious? Plan ETF with a 1,140% total return over 5 years? Right. We definitely need to reevaluate it, because of the 3 times we've ever used it, one time was a small winner, one time was a small loss, the second time was a small loss. So therefore, we need to reevaluate. Give me a freaking break, right? And that's probably what a normal person would think. But not successful traders, not outliers.
and I understand what you're saying. And I think, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results.
Bruh. Boom. By accepting the randomness of the outcomes, you can therefore have consistent results. Okay. Kostya, how do you interpret that?
I interpret that if you have a plan that you've back tested that has a positive expectancy, that even though each individual trade probability is 50-50, in fact, I think Mark just said it just a little earlier, the odds of success are on your side. You just need to have enough trades in your system to have that positive expectancy.
Exactly.
Yeah.
No, you nailed it, dude. Right? Accepting the randomness that on an individual basis, we don't know what's going to happen. But accepting the certainty, or mostly, it's still uncertain, but accepting the reality, I should say, that the more trades we get, the closer we will develop to that edge that we have decided, not decided, but we have calculated ahead of time. Now, again, in that series of trades that you used to come up with that data, there were plenty of wins and plenty of losses. But in practice, that's where people start to break things, right? When they're in the moment, when they're in the trade, when they are in the market at that time. Wait a minute. No, I can't wait until the end of the day to get my signal. Oh, wait. Nvidia popped up this morning. I got to get on that before it runs again. SoFi can never go down, so I will never sell. Even though Chris made me sell my SoFi shares. Like, all of this is real. All of this is would actually qualify as a trading error. Now, a trading error is basically when you do something that didn't go onto the plan. It can also be like an accident, right? Every once in a while, you might sell a call versus buy a call. Whoops, my bad. Let me go switch that real quick. That's the kind of things that are trading mechanical errors, but there are also trading mental errors, which is what we're talking about here. Jumping into things that you wouldn't have taken otherwise, deviating from the plan.
That's an odd concept.
Yeah, that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player.
Didn't we just talk about that on Tuesday? I swear we talked specifically about that.
If the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he will undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique.
Right.
They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do.
No, this gives me all the warms and fuzzies. Because I get this. I understand it. I live it. I breathe it. I try and tell you guys the same things. But it's just so great. It makes me so happy when I literally hear the words that I try and give to you come right out of Mark Douglas's mouth. Because again, he wrote the Bible on trading psychology. And I try and espouse the same beliefs to you. So this is great. I love it.
Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent. I should have an outcome that's consistent with the pattern. And
I want to pause this real quick. I want to shift over to the Tesla chart because this is exactly, precisely, 100%ly what I was trying to get across the other day. The pattern repeated 1, 2, 3. The pattern 10 over 20, price over 50 repeated 3 times in a row. Yet each time was a unique outcome. Does everybody see that? And that's why I also like to say, right? You might make a buck or lose a buck because we don't know where it's going to go. But if it is going to run, the pattern will show itself ahead of time. And your job is to recognize whatever that pattern may be for you. It doesn't have to be the same 10, 20, 50. It can be whatever you want it to be, although it always works because it's math. But the pattern start will always be the same. The pattern finish will never be the same. Pretty interesting, right? Like we want to say, oh, I've seen this pattern before. Oh, I know what's going to happen, right? You're playing Mario. Oh, I remember the last time that I went down this tunnel. I remember what happened last time I was down there. You don't get to do that in the stock market. That is not a possibility with the randomness of the market. I think that was good. I'm glad you mentioned that.
And that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner, this trade, even if the charts are the same, even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly.
Right. And that Tesla example was a perfect real life, real world example. The same setup can result in very different outcomes.
In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to, for us up here, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you.
I swear, this is saying the exact same words I would say, like verbatim. That's so funny. A random distribution of wins and losses over a series of trades.
Might look at. And so, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of emotional trauma that the typical trader does, because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy this issue?
Well, here we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this, is because their initial exposure to the markets themselves is through electronics. Right. In other words, there's through electronics, there's a real disconnect between what you're actually participating in and what's causing you to want to participate in the first place. In other words, markets started as exchanges, and there were, and so when you traded at an exchange, so you know that all prices are people-generated events. Correct. They are, and see, this is what people have to take into consideration. Everything happens because of what people believe.
Remember, if there is a market, that means somebody is ready to sell that asset, and another person is ready to buy that asset at that moment. Those 2 people will never be the same 2 people over again. Right. If today that I bought Tesla shares, I bought it from Charlotte, and tomorrow I'm going to sell it to Mark, and then Mark's going to sell it to Carol, and Carol's going to sell it to Kasia, and Kasia's going to sell it to Shane, and so on down the line. But each one of us is trying to make a profit from that transaction. Now, this can go on forever and ever and ever. And because that, the original trade between me and Charlotte is never going to happen again, and everybody else who happened to be in the trade at that moment to have caused the price to do what it did at that moment, every trade will be unique. Every buyer, every seller, every transaction will be a unique transaction. And it will occur at the point where both of them feel like they're getting a good deal. And that's what drives fear in the markets, and that's what drives greed in the markets.
When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other
In
way
every
to do it?
market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay,
right.
So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points, meaning what you're doing is you're translating the human, the human behavior, the human belief in, if I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like, it could be, yeah, it started out being visual, it started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, or it's going to go to 12. Certainly, if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying...
He's totally right. Remember, we are putting on a trade no matter who's doing what, because we think the value today is less than the value tomorrow, or 10 minutes from now, or whatever. That is the only reason anybody would ever take the trade. If somebody were to take the trade and they don't believe that they have a greater probability of it going up, they would never take the trade in the first place. It's like saying, you know what, I want to lose, let me go ahead and make a losing trade. Now, there are plenty of people who, once they get into the trade, have no idea where they're going to get out, and then they end up being losers. But we're not talking to those kind of people here. That's normal. You guys are not normal.
Buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite. And this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept, how does understanding what moves the markets help our trade?
I want to add a little bit of context there. So to Mark's point, and we've talked about this before, it's the greater fool theory. Right. At some point in time, you will, and I've done it too, so don't think I'm picking on anybody here, but you will be the greatest fool, and there will be no other fool to sell it to. Okay. Just a fact. But in order to go up in price, it must go higher. And when I say that, I mean, people must be getting greedier. People must be clamoring to buy the asset because they think I was actually having a discussion about inflation and deflation with my dad this morning. So think about it this way. So my dad is nearly 80. He went to go get gas yesterday, and boy, was he pissed off because the price of gas went up 40 cents overnight, and he was one mad old man, right? And when he was telling me the story, I'm like, so what you're describing here is what inflation looks like, right? When the price of something goes up, you feel that urge like, oh man, I should have bought it. So I better buy it now before it goes up again. Right. And so then it turns into a vicious cycle where I want to buy it before the price goes up. Because I bought it today, there's less supply. Therefore, they need to raise the price, which means if somebody else is going to buy it today, they have to pay a higher price, which means there's less supply, which pushes the price up even higher and higher and higher. Right. That is how inflation works. And same with deflation. If I don't want it today and I see the prices are coming down, I can say, I'm going to wait. and the prices are coming down, and then I see, let's say for example, I see the price go from 100 to 90, and it's like, well, why would I buy it at 90? If the prices are coming down, I'm just going to wait. And then that becomes a vicious cycle as well, a deflationary spiral. The stock market is that. The stock market is exactly, and we've shown the market cycle over and over and over again, it is exactly those human emotions that drive the price up and those human emotions that drive the price right back down. And it's not theory, it is reality.
To take it to the next level. How does, I mean, is this the first step for them getting control and understanding how the market's working?
Yeah, they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay, you're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. Okay. As a price over time, right. Okay, or with volume. There's any number, yeah. There's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same, mathematical models can't predict human beings. That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. Right. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market, using all of my money, using all your money to if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now the price is at 13. All the trades that you put on at 10 are winners, right? Yeah, but I still bought it at 11 and 12. Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner. That's correct. But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners. So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. We're putting the edge you said in our favor. Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right? Correct. Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner? No, of course not. Yeah, no. And if it turns out to be a winning trade, do you know who those traders were, or who that trader was that actually made you a winner? No. Is there any way to know? No. There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, the firm that clears the bottom line is bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70%.
By the way, don't zone out on this. This is really good information right here. I'm glad he's using not just a coin flip, but a weighted coin flip here in this example.
Of the time exists. Is there still any way for me to know the actual sequence to heads to tails? Of course not. It's an infinite. Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically, it's going to come up heads 70% of the times. I still don't know which flips are going to heads. Which flips are going to come up heads. They say which flips. It's not the times.
And that's what I try and get across. That's right. Even though if we do this enough time, we're going to hit 70% on that coin flip. Each individual trade, we actually don't know if it'll be heads or tails. It could still be weighted 70% towards heads, and you get 10 tails in a row. It can absolutely still happen. You can have a 70% win rate and still have 10 losers in a row. Sucks, but we don't get to to choose those distributions. We don't get to choose when the wins and losses happen. Because, Mark, if you could choose when something was going to win or when something was going to lose, what would you pick?
Well, I mean, if I could choose, I'd be retired by now, sitting on a boat somewhere.
I mean, exactly, right? However, that's what a lot of people feel like, right? And I remember specifically seeing this one time. It said something like, Chris, if you're so sure about this trade, why even have a stop loss? Well, what if it doesn't work? Well, of course it's going to work. It's set up 100%, right? It's got all outlier 9, stocky locky. You found this trade that's got all outlier 9 in place. It should be golden, right?
Yeah, take trades. Go for it.
Anybody else catch that? I couldn't hear what he said. No, it's okay. William, you jump in here, William.
Sorry, ask me that again. I'm over here.
If you had a trade that's 100% set up based on your plan, there's nothing to worry about, right? It's always going to work out.
Well, obviously, I mean, I pay 82 cents a day. I would think it would be 100% win rate for that price.
I mean, we must give you the Nancy Pelosi special if you got that 100% win rate. All right, let's keep going here.
Which ones? In other words, which, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails. The next one's tails. The next one's tails. In other words, we could have streaks of heads or tails. Okay, we could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have 70%.
So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words,
did anybody else hear him say, if your trading plan sets up, you are obligated to take the trade? Anybody else hear that? Rick, have you ever heard any random guys on the internet say anything like that before?
I think I've heard it once or twice, maybe once or twice a day.
Dude, for real. And that's the thing, is that, to his point, if everything is set up, you have to take the trade, because we don't know if that will be the one that will be the winner or the one that will be a loser. And that trade is completely different from the trade before and completely different from the trade in the future. Does that make sense, Rick?
Yeah. Absolutely.
Very cool. I'm glad that's making sense. I hope that this video is coming across very useful to everybody, right? Because I mean, I can say literally the same thing twice a day, every day, but it still doesn't sink in for most people.
we have to, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it?
Exactly. Oh man, that is what normal people do. Why would I ever take the trade if I don't think I'm going to win? And if I don't win immediately, that's okay. It wasn't supposed to be like a 1 week trade. I'm just going to be a long-term investor until it comes back. I don't know if you guys have heard that. Hey, Carol, have you ever heard anybody talk about that, right? The trade didn't work out, so I just decided to be a long-term investor.
Yeah, exactly. And hold on to it forever. 3 years to turn around, whatever the number is.
And for us outliers, and for those who pay attention, especially, you know, Bravo class and Alpha class, you guys understand the importance of just admitting you're wrong and moving on. For normal people, that is so hard to do. That is so hard to do because, man, I don't want to take the loss. I don't want to cut it off, because what if it does come back? And especially with selling options, good gravy. When you've got that window of, you know, I've got 14 days for it to come back. I'm just gonna, you know, surely it'll come back, right? I had 84% probability of winning this trade, so surely it's going to come back, right? And then day after day after day, your losses spiral out of control. That's normal. That's normal. And that is not how to be exceptional in trading.
And it skews our expectations. See, it messes our expectations.
Well, let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, and this makes a whole lot of sense to me, and I hope it's getting through to you guys, we have a tool that gives us an edge. whatever it is.
Right.
Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. I was using edge defined as
I see.
Yeah.
Okay.
So maybe 55 or 56% of the time.
Right.
Let's just say.
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too.
A little bit of jargon breakdown right there. An edge is your expectancy, which is your win rate times your average win minus your loss rate times your average loss. That'll give you what your expectancy value is, your average outcome amongst every single trade. But that's not your win rate. Your win rate can be anything. Your win rate could be 20%, and you can still be unbelievably profitable if your wins are, at least 5 times as big as your losses.
That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis.
Richard Dennis, y'all ever heard of that guy? Y'all ever heard of that guy? Funny, because he specifically did exactly what we're doing in Outlier University, which is teaching people how to trade. Charlotte, are you back? Is everything working over there? Everything's good. Okay, cool. So Charlotte, do you think that people can learn to trade or that traders are born with it?
100% can learn.
Absolutely. Yeah. And
So.
I take I get actually offended at the idea that somebody is so arrogant to say, you can't trade. You're too stupid to trade. Don't you understand? I was born a trader. And so therefore, I didn't have to learn anything. It just came naturally to me. And so therefore, I am a successful trader. You are just a peasant among royalty here. No. God, that irritates me so bad. But people actually think that way. They did in the 80s and they do today. I'll just look at the chart. I can tell the future. Bull crap. But if you have consistency and discipline, you can come up with a plan to have an edge and then execute that edge and make masters of the universe money in the process.
95% of his trades were losers. 95%.
He may be exaggerating there, but I'm sure he's got a point.
But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make at the most at one point, and I think around 1987 or 1988,
Now,
he had $400 million.
Is that using his edge or his money management or a combination of both?
Of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment,
okay,
and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations, aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, right. But what he does think about,
and that's why when you see me trade, I trade so flippantly. I will buy, I will sell, I will win, I will lose, and I'm not impacted by it whatsoever, because everyone is random. I had nothing to do. I did not go into the market and say, Mr. Tesla, Mr. Elon Musk, I need to go buy some Tesla to help boost up the price. No. However, so many people want to wrap their listen, I did this too for years, wrap my self-worth around if I had winning trades or losing trades. I would feel like a loser, and this is why I went to a psychologist, by the way. I would feel like a loser even when or because of having losing trades. And then as soon as I would have winners, I would go on tilt, thinking I can't lose. I got the Midas touch. And then that's when I recognized this is broken. This is not working. Right? I had problems at home. I had problems at work. I had problems in trading. I had problems everywhere. And the problem was me. And that's why it takes a lot of work to overcome the hardest part of trading, which is the game between your ears.
About is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan.
Well,
Or
they
they
usually
think
don't
about
have
the
a plan.
trade too much. They think about, is this going to be a winner? Is this going to be a
That's
loser
right.
for me?
The exact opposite of the professional.
So what the professional does is basically,
and then once they make up their mind that it's a winning trade, they don't predefine their risks, do they?
Right.
And they also don't have a plan to take profits because they think when
They think
they're
it's gonna
winning trade, it's going to go on.
and I don't want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win, and how much he's willing to lose or risk.
Right.
Now, does he put a cap on the upside? Does he put a cap on his win
Well,
side?
it's not a matter of
We talked about this just last week. We get to decide how much we make, and we get to decide how much we lose by following the plan. The outcome will actually be random. You know, if it's $1, if it's $1,000, the outcome will be random. But we get to decide how much that'll come into our account because of a plan. And by having that plan, it makes it so much easier, right? So tell me, just raise your hand if you've traded without a plan and you had no idea where to get out. If you traded without a plan, had no idea where to get out, right? Exactly. Now, raise your hand if you felt this overwhelming sense of calm, at least I do, because you knew exactly where you're going to get out because you had a plan, right? There's no stress here. And if trading is fun and exciting, you're doing it wrong, because all you got to do is look for your entry, wait, look for your exit, wait, execute the exit, move on. That there is such a freedom in knowing that, and that's a book by Jocko Willink called Discipline Equals Freedom, because it's exactly that. You don't have any mental space occupied by what am I going to do? What am I going to do? What am I going to do? Unlike the normal trader, which is, oh man, if this goes down any further, then I'm toast. Or I can't believe how much this has gone up. This is so exciting. Versus, this is where I'm gonna get in. This is where I'm gonna get out. Not gonna do anything in the meantime. Cool, calm, and collected. That is how a fund manager, that is how a professional operates in the markets.
a cap. It's a matter of how his assessment of how much potential there is. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk to reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time, as I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on.
Okay. I don't think there's actually a break, but I am going to call on a couple names, and I want you to give me something, some sort of takeaway that you've had so far. Art, Mr. Senior Wahoo. What's one of the takeaways that you've got so far from this?
You have to believe in your plan and stick with your plan, and try. And I'm in the middle of his book right now, and it's the acceptance of how the market. You have all these options in the market, tons of options in the market, and that's super exciting, but it's also super scary. So you need to be able to accept that and not have any emotion with that, and just stick with your plan and stay focused. I got into PR last week, and it was running up into the order block. I got out. I made 23% on it last week. It was perfect. I stuck with the plan. It was all 9 lit up last week. Last Tuesday, it was awesome. Just stick with the plan. And I didn't even think twice about getting out of the trade now. 6 months ago, I'd be like freaking out about it. Is it going to get through the order block? Is it going to get through the order block? I'm like, I just stuck with the plan. 23%. It's not normal. I like it.
That's right. I love it. You touched on something. One of my favorite parts of Trading in the Zone, the book, the author Mark Douglas is who we're listening to today, is that there are unlimited opportunities in the market every single day to do unlimited things. Right now, meaning you can go into the market and you can buy Tesla, you can buy SoFi, you can buy Nvidia, and you can buy Palantir. And then you can sell all the above. There's nobody standing there looking over your shoulder saying, don't do this, you know, do that, do this, right? It's you don't have a boss because you have unlimited freedom to do anything in the market. A lot of people screw that part up, right? They have the freedom, but they don't know what to do with that freedom. And so therefore they just run around like a chicken with their head cut off, buying, selling, being FOMO'd into things, being panic sold out of other things. And at the end of the day, they look at their bank account and they're like, why do I have less money? I put all these trades on. What happened? Well, you didn't have a plan. You had all the opportunities in the world to do whatever you wanted, and you took advantage of those opportunities, even though you didn't need to. All right, let's keep going. I hope y'all are enjoying this.
WTV. The market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads. Right. Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern. Right. You also talked about how
it's the word right that's really critical here. Okay.
Ooh, you called something. The word right. Good trades, bad trades, winning trades, losing trades. Remember.
Right. It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information. Right. So for an example, if I'm in a losing trade and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case.
Getting into a trade thinking you're going to be right, not following your plan, thinking you're going to be right. It's a key aspect here.
Right. You know, it's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right, I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks I've traded, but just for some particular reason, I feel great about this stock. Mm-hmm. Don't know what it is, but maybe they had some great news out, and I feel that
SoFi bros, it only goes up from here. I know Shane owns all the SoFi, right, Shane?
Oh yeah, I love SoFi.
Shane, SoFi bro for life. SoFi bro for life. So imagine he's talking about SoFi here, just for example.
Stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position.
Okay, now that you associate it with like an actual stock where people actually get so emotionally involved into it, doesn't that now start to ring true? Don't you see that this is not an example? This is actually real life, right? People will hold on to it because they got that special feeling. This is the future of finance, bro. Don't you understand? Palantir, same thing. This is the future of AI, the future of surveillance. This is going to change everything. Shane, fellow SoFi bro, what's on your mind?
Yeah, me and Sophie. No, but right now I'm witnessing it firsthand with a couple people I work with who are like Bitcoin bros, and they've literally watched their entire profit just wither away because they're like diamond hands. And I even send them links to Outlier to show them, what to do, but they don't want to listen.
Dude, diamond hands will get you cut all day, every day. You want the mostest paperist hands possible. Nothing's harder than a diamond, and nothing is more hard-headed than somebody with diamond hands, I guess.
And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring
SoFi is so special.
to?
Well, yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto.
Okay.
The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good.
Right.
And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. That my reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter.
So, wait. Oh, I'm not gonna do it. I was gonna say it doesn't matter what you think. Y'all saw that coming. I know you did. One of the reasons I think that people put out the $25 in this stock and you'll retire at the end of the year might be specifically because they need you to buy it. They need you to help pump the stock, right? Their job, that what they need is somebody else to be the greater fool to help push the price up higher, because it's been trending down for so long. They feel like an idiot, and they're like, listen, this is exactly what happened in AMD the first half of the year before it bottomed, had the trend template change and went straight up, right? Was, bro, don't you understand? Don't you understand? AMD is going to go to the moon. Let's ignore the fact that it's already down 50% by the time I'm telling you this, because it's going to the moon, okay? And it's going to go down another 25% before it ever goes back up. But please buy some so my price goes back up, please.
Because it's not a winning trade. And so, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you
by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
For whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay, you play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random. It's
a random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome,
right? And
as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly. Okay, because
so this is a really good point. And Mark, I love that we talked about this a couple of weeks ago. He paid a quarter to find out if he was going to be a winner. Right? That kind of goes back to what we were talking about as far as like accepting the risk when you put on the trade. I'm going to pay, let's say $1,000. I'm going to pay $1,000 to find out this is going to be a winner. And if it's not, that's okay, because I still got, 100,000 left or whatever. The point with that is when you go into the casino and you put it in a slot machine, you don't get all hot and bothered and upset if you put in the bet and it loses, right? Right, Mark? I'm talking directly to you. If you went into the casino, you put your money in, would you be upset if it turned out to be a loser?
No, that was your expectation. So why would you be surprised?
Exactly. But to the same regard, Would you have a completely different feeling if it were a winner?
No, I mean,
Probably so.
you'd
Probably
be,
so.
yeah, you'd be happy.
Yeah. You would probably go around telling people, I am such a good gambler. I am so good at slot machines. I am the guy. I'm the one guy who walks into a casino, sits his butt in a chair, and wins on this machine. And then I go to that machine, and I go to that machine, and I win on all. I'm such a good gambler. But never mind the 1,000 coins that you put in ahead of time, or the 1,000 coins you put in between the winners. Am I right, though?
Yeah, we treat it differently for some reason, and we shouldn't.
And that's one of the core things, and maybe he'll talk about it here, is that a winning trade and a losing trade are just as equally likely to happen on a 50-50 on a distribution, right? The distribution of wins and losses will be random. And because of that, we shouldn't get down on a win, and we shouldn't get down on a loss, and we shouldn't get up on a win, because it was just as likely to happen either way.
So because the odds aren't exactly in your favor, and what trading systems can do is actually put the odds in your favor in a way where we own the machine, believe it or not. I mean, this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money.
Right. We paid to find out if we're going to be a winner. All right, Kostya, you went to that machine, you put your quarter in, you basically are paying. Tell me if I'm going to be a winner or not. That makes sense?
Yeah, 100%. And the strategy that I've heard from Outlier is kind of buying a call is, to me, it seems very similar in a good way. That I am putting, like, I know my absolute maximum that I could lose, even though I would never hold it till it goes to zero.
Yeah, exactly.
So I accept the risk the second I place the order. And that's actually quite gratifying, as opposed to any other complicated strategies that I've seen where you can lose 5 to 8 to 10 times the amount of money that you put in. And I maybe have done it once or twice.
Yeah, for sure. You're totally right. Mr. Skinny Buff Guy William, is this ringing true to you? Is this making sense?
Yeah, absolutely. Actually, I was jotting down a couple of notes in case I got called out. I actually wanted to talk about
Here
this.
we go. Here's your chance.
Yes, finally. Be prepared. Have a plan. So I always think of the people, and I've done this so many times, you're waiting to find that next Tesla, right? And maybe we can call the SoFi bros that same group. Man, it's going to go to 100 because the executives get bonus based on, the stock price. So it's going to go to 100. Okay, maybe it will. Maybe we could put a plan in place instead of just saying, hey, I want the next AOL, I want the next Netflix, Apple, whatever that big company is. There's a way to find it. Come up with a plan that's mathematical. When your 10's over over the 20 and your price is over the 50, these are some basic principles that most traders follow. I might have heard that from some professional on YouTube.
Random guy.
And maybe you'll have a chance to catch one of those, Maybe you won't catch the Netflix in 2011, but maybe you get it in 2012. I see all this stuff where it's like turn $1,000 into 500 or 500,000, or turn that $75 into $1 million, right? And it's like, well, you have the ability to do that. You don't have to speculate. I've certainly bought stocks. Like I bought Nikola. It was like a hydrogen trucking company, and I thought, oh, that's the future, right? We're trying to go green. Okay, maybe not. I think they're out of business now. I could be wrong. And then there was actually a second part too that I kind of just wanted to make a point of. One of the books that we're reading talks about the even sum game. We're in the market where my money's going to you, your money's going to me, some random other person on the other end of the world that's buying a stock or selling a stock is transacting with me. And the way I look at it too is it is like a casino, but you can actually be the casino, because if you've created that plan that has the edge, you can take advantage. And this, I don't want to sound shady when I say this, but you can take advantage of the people that didn't have the plan, that don't have the edge. If they're going to put their money in there thinking, hey, I'm speculating that SoFi is going to $200, I'm following a trend. I'm going to use a mathematical formula that allows me to have an advantage, as opposed to just saying, that's got to be the future. I hope it works out.
You're 100% right. And that is, at the end of the day, we really are trying to take advantage of others' fear and greed, right? We use the fear and greed scale, we use the buy and sell signals, and we can see when something's getting more greedy, and we want to ride that wave. But there will be a point in time, and it makes obvious sense. And that's why I like to show that curve on the market cycle, where the herd buys right at the top, because that's the most greediest time. Everybody just heard about Tesla going to the moon. So everybody's bought it. And if everybody's bought it, they're going to be terrified. They're going to be like, I don't know if this is going to go up. And then the first downtick, they're going to start selling. Our job is to take advantage of everybody else's fear and greed, make as much money as we can, and get out of the way once it stops getting more and more greedy, because once everybody's greedy, the only thing left for them to do is turn fearful. So you nailed it, dude. Yeah. What's up, Rick?
I've got an interesting story, actually. So a couple of years ago, we were on holiday and we saw one of those arcades, and my son, who's probably about 6, maybe 7 at the time, he saw one of those claw machines, where it pretends to grab the toy and it just takes your money. And I tried to explain to him, oh no, it just fleeces you, it's going to take your money, but he didn't really understand it. So I thought, he needs to see it. He needs to see it happen, right? So we put the money in and he's getting all excited and the claw moves and then it does that thing where it half grabs it and it drops it. And he was so upset. The injustice, it took my money, And then a couple of years later, we're on holiday again, and there's a big arcade at the holiday camp, and it was one of those ones where it has the toy hanging from the string, right? And you have to try and cut the string with the scissors. And again, he was like, "Oh, this big, this massive toy that he sees," and I said, "But remember when we played the claw machine and it took your money?" He said, "Oh yeah, okay, but can we just give it a try?" So we went over. We put the money in, and then I noticed that I can get around the side of the machine, right? So I can see when the scissors are lined up with the string. So maybe I've got an edge, right? So I move myself around, I press the button, I managed to stop it perfectly. It cuts the string, this massive teddy drops out.
Oh, that's so sick.
And at the time I thought, this is so bad, because the whole point of playing it the first time was to teach him this lesson. But I've just realized now, actually, this is it's taught me this lesson, right? So sometimes you have to pay to play, to find out whether you're right, to find out whether you've got an edge.
Right.
But yeah, I mean, we ended up with this massive Mario, and we had to squeeze it into one of the suitcases to get it home on the fly.
Oh, that's a great story. Man, that's so fun. We went to, there's a place in the Dallas area that's a claw machine. Like the only thing they have there is claw machines, and it's $1 per grab, right? But if it doesn't work, you can ask one of the employees, be like, "Hey, can you help me with this?" They'll open the machine, they'll kind of rearrange things, and they'll set it right on top. It doesn't mean it's going to guarantee it, but it's going to get real damn close. And if you do it just right, a little bit of practicing, you'll eventually get it. My son Elliot, he loves those things. And trading can be that way, right? You wait, you call the assistant over to come make sure all the stuffies are right there so you can grab it, and then the machine comes through, and sometimes it picks it up and drops it still, and then it comes through and it picks it up and it takes it, and you're a winner, right? There you go. We made the correlation back to trading. Nice job, Rick.
Out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay. And then what we do is we wait for a pattern to show up. If the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. The pattern shows up first, okay? Then what we have to do is put up our money, meaning how much am I willing to risk to find out if it's going to work? But Most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right. They actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. Right. How many people put stops in the market and take them out, and then and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it, but they haven't really accepted the risk.
You see that every day.
Yeah,
every day.
That was me. Oh my gosh, that was me to a T. I'm going to get out at 99, blows through 99. I'm going to give it another day, blows down even further. I'm going to give it $2 more, boom. Now it's down to 85. And I'm like, son of a B, if I had only stuck with my plan originally. Larry Height specifically said to me, your stop can only be moved up. You are never allowed to move your stop down. But if you don't make an automatic order, then you have to be the one that actually clicks the button to make it happen. So one way to get around that, if you haven't accepted the risk and you're still struggling with it, is to actually put automatic orders in the market. And then there's nothing you can do. I mean, you can go cancel the order, but in theory, if it gets there and it's gone. So I wouldn't recommend that to everybody, but if you really struggle with following your stop losses, that is a way around it.
Yeah, they haven't really, truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right.
Isn't that cool? Right, just you can see the passion in his eyes. You can see how much he understands the game, and that he's trying to get you to understand. You're never going to predict the future, but by embracing the uncertainty, you actually can become exceptionally profitable.
Which is another problem I want to say.
Oh, yeah. But see, the thing is like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
And how does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just it's just like anything else in our lives. When we realize that there's a particular goal that we have, and and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But
Stocky Locky, have you ever come across something where you're like, I will never stop doing this until I'm successful? Right? Have you ever been so passionate about something? It doesn't have to be trading. I'm not trying to edge you towards trading, right? But has there ever been something where in your life where you were like hell bent, there is no other outcome other than me being successful?
Yeah, I think there's going to be a few occasions in my life where I've been like that. I get obsessive, so similar to how I am now with trading. But I remember being younger and working towards learning to ride a motorbike. So beforehand, it was scooters, the little 50cc scooters. And then I remember a friend of mine having a motorbike with gears, and I was like, right, I want to learn how to ride that. That's so cool. And in the end, went through the motions of learning how to ride the bike to the point where eventually I ended up passing the tests and being able to ride motorbikes. But the point was getting obsessed with that. That's the goal. That's what I want to achieve, and I achieved it. But there's a few times in life where I think when I want to achieve the goal, I just completely focus in, hone in on what I want to learn, and make the most of that.
Yeah, that's a great story, a great example, because you can see what the outcome will be, right? Once I get my license, once I pass these tests, and I can ride a motorcycle or a motorbike or anything with 2 wheels and a motor in between, anywhere I want to, and I can do it all day, every day, and twice on Sunday, right? Now, that's the kind of passion that you have to bring to the market. And if you just half-ass the market, you're going to get half-ass results.
100%, yeah.
Yeah. So, and you can see the passion in my eyes when I talk about it. And, you know, there can be cycles in your life where you get super excited about it. Once you understand what you need to do, once you develop a plan, then you can go on and focus on other things, because then all you have to do is execute the plan. But I would bet you every day you get up, well, I'm assuming every day you get up and you brush your teeth, right?
Yes, yeah.
I'm assuming.
I know I'm British, but yeah, we do.
Yeah. So the trading can end up being like that with you as well, because at one point in time you had to focus and learn how to brush your teeth. At one point in time you had to focus and learn how to ride the motorbikes. At one point in time you had to focus and learn how to do everything. But after you do it enough times, it becomes second nature, and then therefore you can devote your brain space into something else because you already know what you're going to do.
Correct, yeah.
I think that's super freeing. I think that that'll change the game for everybody. Is you don't have to obsess about this for the rest of your life, but you do have to obsess about this until you get the point where you become a profitable trader, a consistently profitable trader, not just every once in a while. Charlotte, is that ringing true for you? Does that make sense? Sorry, you were muted. Go ahead.
Totally, it makes sense.
Yeah. So I want that for you guys. I want you to get to the point where you've got so used to your plans, so used to following the consistent principles to achieve those outcomes, that it literally becomes boring AF, just like brushing your teeth. Right? Let's keep going.
But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay. And that's why there's so many people who are so close to getting it, but never really get beyond that
What's
threshold.
that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got it.
Carefree state of mind is exactly what I was trying to describe for you guys right there. Now, I'm telling you, I struggled with this. This was one of those concepts in Trading in the Zone that I really fought. Carefree state of mind? What do you mean carefree state of mind? Anytime my money's in the market, I can't even breathe. I'm so stressed out. Carefree state of mind. What is this guy smoking? But as we just discussed a minute ago, you get to the point where it becomes so second nature that you have no emotional impact, win or lose, because you're just following the plan. It's just going to be what it's going to be.
They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do
got
evolve.
an hour and a half, by the way. Keep going.
We do? Oh, okay. Well, yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development, that we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right. On. And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some of the traders didn't come into the market that had the same belief that you had, or the same conviction that you had about this market doing whatever it is you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? In someone else's behavior. People aren't that good at predicting other people's behavior. or even their own behavior for that matter. Okay,
Exactly.
they find themselves doing things that what am I doing this for? You know, and so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade by trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology at the very most fundamental level, what this is telling me,
right,
is that
fresh cross.
There's a higher there's a high, or let's say the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now they're either going to come or they're not. And so as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out, not worth the cost of finding out.
I've mentioned this before, and I heard it in the How to Make Money in Stocks book from William O'Neill, and that it's a winning racehorse doesn't back up into the gate. Right? If a trade's going to work, it's going to work quickly. And if it's not going to work, it's not going to work quickly, which is great. That's exactly what you want to see. You don't want to have to wait weeks and months, years to find out if it's not going to work. If it's going to work, let's let that dude run. And if not, it's okay. Just move on.
That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DVD.
Yeah, absolutely, but not like
very
specific. Not the kind of specifics that like if you're in a half an hour time frame, how much.
Well,
how
that's
much
the trader's decision.
Yeah,
but the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to their risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing the risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can, from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm only going to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely. Yeah, absolutely. I mean, and that's what I suggest to people, all the time, especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and, they'd get into a situation where they're on a pretty good losing streak. And often it required that they actually go back to a risk level that, they hadn't. Meaning that if they were trading, 10,000 or 100,000 shares, or willing to take, $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that
building up your confidence, even going down to one share, building up that confidence of, oh, okay, this is what it's like to win. This is what it's like to lose, right? Then the emotional aspect goes away. Now, granted, I know somebody's going to be like, oh, you could just paper trade. Raise your hand if you've paper traded before. Okay, pretty much everybody. Raise your hand if the first time you put on a real trade, you're like, holy shit, this is totally different. Yeah, it changes the game. So by going to one share, you can actually get used to that feeling again. Okay. And then building up, right? I saw somebody mention this in the chat earlier, but I'll mention it as well. In May, I believe it was, when we started trading again, I had been in cash for so long, and it was going to be the biggest position size I'd ever put on in my entire life. I had to go in the mirror and I had to pump myself up. I'm like, listen, you have a plan. You know exactly what you're going to do. All you have to do is follow that plan. Win, lose, or elsewise, your plan has an edge. And if you do this enough times, you're going to come out ahead because of the edge. And you may need to do that too, right? Start thinking in those probabilities. Start saying to yourself, it is okay if it's a winner, and it's just as okay if it's a loser, because we can't control what the outcome ends up being. All we can control is what we do.
I mean, look at it this way. Paper trading. Okay, paper. A lot of people who teach trading say that there's no
I didn't know he was going to go into paper trading.
point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to familiarize yourself with your trading platform. It's a good way to really get confident with your methodology, but more so, it is a graphic representation of the mental skills that you don't have. That's an interesting concept. Yeah. So in other words, how does someone convince themselves that they need those mental skills? Look at your paper trading. Look at your paper trading in relationship to your real trading. Now, if there's and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss, right? Because the way our minds think. In other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendency to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up.
This is what I told y'all to do as well, right? You want to start small, get used to what it feels like, and then maybe you go from 1 contract to 2, 2 to 4, 4 to 8, 8 to 16, whatever, until you can finally scale up to, the appropriate position size for you. And I would never, ever, ever tell anybody to jump position sizes, meaning this happened to Mikey Mike, one of the alphas. He was doing really well at 1% position size. He was understanding, it was clicking, he made money, he was totally on board. He's like, okay, I get it. Chris trades 7%. I'm going to go up to 5% and see how that goes. He jumped from 1 to 5%. That first one, once he hit 5%, was a loser. He did nothing wrong. He knew exactly what he was doing. He followed his plan to a T, and all of his profits were gone. If that same one, he was at the 1% position size, he wouldn't even noticed. And so that's why you have to scale into position sizing, right? Because not only is it from the emotional side of, oh man, I can't believe how much I made or how much I lost. It feels really different when you're trading 100 contracts versus 10 contracts. But it's because if that one happens to be a loser, then all of your gains just got wiped out. And we don't get to pick if it's going to be a winner or a loser, unfortunately. So and Mike, I know he's listening, and I'm sorry. I'm sorry, dude. But unfortunately, you did nothing wrong, and that's why I told him at the time. I'm sorry, dude. There's nothing I can do about it because you did everything right. It just happened to end up being a loser.
Up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. And that's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at Wise Fest, and earlier we talked about some events of pain, pain in your life, and a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, you know, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change?
You're not gonna like my answer. I don't know any trader who has not blown up at least one account. I've blown it twice. I don't know any successful trader who has not blown up at least once. Now, Mark may say something completely different. And that's why starting smaller is a lot easier than starting big. But also because most likely you're going to find a strategy that's working for you. Everything's great. And then you abandon the plan, you abandon your risk management, you start going off the plan. Next thing you know, you haven't traded your plan in months, and you look back and you're like, what has happened to my portfolio? If I had only stuck with my plan and got to the carefree state of mind of, it's going to be what it's going to be. The carefree state of mind, just like Stocky Locky, who, even though he's British, does brush his teeth. He brushes his teeth with the carefree state of mind, right? Because he knows what he needs to do. No big deal. Your trading will eventually get to that point. And I really hope that Mark says, no, people don't have to blow up. But I can say personally, I don't know anybody who hasn't blown up and been successful, because there's that wound that will never heal. I will carry those 2 wounds until the end of my days. And because I know that those wounds exist, I am never going to let that happen again. Let me ask you guys this. Has there ever been something in your life, and if not, don't feel like you don't have to share. Has there ever been something in your life where you lost whatever that was so hard and so bad, you were like, there is no possible way I'm going to let that ever happen to me again? William, do you feel like sharing?
I mean, I don't know. I mean, it might not really fit into the trading thing, but I mean, like, we've all been in maybe relationships and things like that in our lives where we haven't done the right thing or always made the right decisions. So, you know, sometimes you have to lose something to realize that, hey, next time you might be a little different. I'm just saying that kind of generally, but, you know, or maybe you made a financial decision that you wish you hadn't, but now that you did it, hopefully you learned something and you don't repeat it.
Yeah. I think it's those mega failures in life that can teach us the most if you're willing to listen. And listen, it took me twice to figure that out. I was so stupid. I couldn't have figured it out the first time. I had to do it twice. And now I know that here in Outlier University, 50% of the audience is going to listen. They're not going to do anything about it. They're not going to change their lives. What's one iota, one ear and one out the other. 25% of them, they're going to listen half-assed. Then they're going to go out and they're going to make all the wrong decisions, and they're going to blow up their account, and they're going to say, it's all Chris's fault. I listened to something Chris said one time ever, then I never listened to anything again. And I implemented it, and that 10, 20, 50 didn't work. Whatever. Then there's 25% of you who are going to be like, wait a minute. Chris has actually laid on a lot of landmines to get me to this point. Chris has taken all the bruises. Chris has been taking all the cuts. His back is scarred beyond belief. Taking all of this so you don't have to. And if you understand the point of why I do what I do, you'll get why I'm so passionate in the way that I am, because I want you to be successful and I don't want you to repeat the same mistakes that I did. So let's see what Mark has to say.
Or can someone just in the normal course of every day with a little bit of dedication, actually, and I'm not trying to be rhetorical here. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You aren't in pain right now, are you, Jared?
What's that? Yeah, I'm good. I've been out of the market a
I'm
little.
Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring to?
Explain the gutter principle.
The gutter principle. In other words, how much in the gutter do you have to be before you're willing to say, I'll do anything?
Mm-hmm.
As a matter of fact, this kind of brings something up. Is that when I was actively coaching, my coaching clientele basically fell into 2 broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine tuning. Okay, they wanted creative ways of fine tuning themselves so that they could actually increase their, increase the amount of money that they make over a year, whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated. They're so frustrated because of the potential that it's so obvious what the potential is. And yet there seems to be these invisible barriers that keep them from getting into that potential, that they come to me saying, I'll do anything. And that's, now everyone has different tolerances of pain before they get to the point where they say, I'll do anything, and mean it, and be sincere, and mean it. That's the whole thing. They got to mean.
And that was me when I started working with Steve Burns. Steve, I know that people are successful in the market. You're successful in the market. I will do anything to find out. And then Steve put me in touch with 5 of the market wizards. I know that you guys are successful. I will do anything to find out. That's the level of dedication, the level of perseverance, the level of I will never, ever, ever stop doing this until I can brush my teeth correctly and trade correctly. It's either die or figure this thing out. One of these is going to happen first. I would prefer to figure it out and then die. I'm just saying.
Mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up the show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders or any final thoughts? Maybe a mantra, something.
No, just basically just to kind of, sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profits. But I'm saying the pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is because the objective part about trading.
You can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
Okay.
so we've got plenty more time to go. One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10.
Mm-hmm.
How do you define edge as a closing thought?
Just simply an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, like for example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back.
All right. So we're gonna leave off there. I know this has been ultra long today. I think Mark fell asleep twice. I also have the old man narcolepsy as well, Mark. Just give me a hard time, dude. But in all reality, we're going to be working on our edges. Not next week, because that's Thanksgiving week. Everybody gets the week off. But after that, we will be working on our edges. What does that look like? And I actually want to learn from you, right? I want to see some of the things that you found that you're putting in your plans, and then we'll work on it as if you've never traded ever before. How do we develop an edge, right? Because a lot of people who are going to watch this now or watch this in the future, they're going to say, how am I supposed to come up with a plan, Chris? I've never traded before or anything. So this is what we're going to work on next week or the week after. So listen, I really appreciate you guys. I know this took forever. but this is by far one of the greatest trading psychologists ever. And we're blessed beyond belief because we can actually learn directly from these people, right? Imagine the 1980s, you'd have to pay $100,000 to hear what he just told you in the last hour. But thanks to technology, we can watch this on repeat. We can watch this as part of Outlier University, and it costs nothing. So if somebody were looking to save time, make money, or start winning with less risk, what do you think that those people should do? Do you think they should click over here, over there? It's pretty much over me and Mark right now, and over Kashi and Shane. Although Shane is in the dark, he's trying to hide the fact that he's watching videos in the dark. All is good. Thank you so much for coming today. I will see you not next week, but the week after. So we'll talk soon.